Welcome everyone. Hi traders. Good to see every single one of you at our fourth session of the webinar series. And thank you for everyone who's been with us here throughout all previous sessions. And a special welcome to those of you who are joining for the first time today. Let's start with a quick tech check. If you can hear me and see my screen, can you please drop a plus in the chat? So I know that everything is working fine and we can dive into the topic of our today's stream. Can you please put a plus in the chat if you can hear me and see my screen, and we are going to get started. Perfect. I see pluses. Is the sound good? Can you please also put a yes in the chat if you can confirm that the sound is good? Just making sure that everything is working fine. Okay, I see more pluses. Thank you so much. Perfect. I see your responses. Thank you. Well, my name is Anastasia Demishkevich, and I'm a trader with 8 years experience and an expert of Aras platform. I started trading crypto in 2017, then moved to Forex, and for the past 4+ years, I've been fully focused on US futures, using nothing but volume analysis and order flow tools to make trading decisions. And you know what changed everything for me? It was the moment I stopped relying on standard charts and indicator and started asking myself a question: why is actually the price moving? Who is standing behind those moves in the market? And a lot of technical aspects, a lot of parts of the technical analysis gave me the moment of making a decision, but they didn't answer this question. So I felt like there is a big missing puzzle that is not enough for me to understand clearly what is behind my decision making. And it was taking a big part of my confidence away from my own trading. Okay, so over the past few webinars, we've been diving deep into what was my personal breakthrough in the trading career, and I do hope that it also became yours. We learned how to read clusters, so footprint charts, and track the balance of buyers and sellers, how to identify key support and resistance zones using volume profile and vertical volume, how to spot reversal signals using volume analysis and footprint before the price even starts moving, and much more to help you understand what's really going on under the hood of the market. And today, we are finally diving into the big question that every single trader cares about: where and when to enter the trade. In other words, how to use order flow analysis to find key entry points where institutional traders are active and where we as retail traders can get an edge. And no more guessing for every single one of you who is joining these webinars, because we will be learning how to read the actions of other traders directly from the chart. But before we're going to dive deeper, let's quickly look back at the journey that we've taken together already over the past few webinars. On the day one, we covered the basics of market mechanics. We've learned that the market is an auction where the price is essentially moved by aggressive participants. We got introduced to the tool called the depths of market, also the smart tape, and took our first steps in understanding order flow. On webinar number 2, we went deeper into footprint charts. We learned how to spot bursts of aggression inside candles, how traps form, and where the strong side meets the resistance. On the webinar number 3, we explored vertical volume and how it ties into footprint analysis. You learned how to identify zones of interest from large part players and what kind of patterns emerge where volume spikes intersect with clusters activity. And finally, in the webinar number 4, we added one of the most powerful tools in our trading toolbox, and a key to understand market structure: the volume profile itself. And today our focus is how to find and master key entry points using order flow signals. We will break down 2 high profitability situations where order flow gives you a clear signal to act. The first is going to be an absorption, where the large players hold their ground and refuse to let the price through. And the second one will be imbalance and cluster aggression, when initiative shifts hands, and the key is spotting that exact turning point. You will see on the charts exactly where the signals live inside the footprint charts, how to recognize them, interpret them, and apply them in your actual trading, and the most importantly, how to avoid getting trapped yourself in the same zones. And just the heads up, everything I show you today you will be able to test on your own after the session. To do that, you will need to have the ARAS platform installed and ready, along with the workspace file, which I will be sharing with you right after this webinar. Quick question for you before we're going to get started, and you can drop your answers in the chat. What is the hardest part for you personally when it comes to finding the entry point? Just 1 or 2 words. It can be hesitation or fear of entering the trade. Maybe you don't have a clear signal, or you feel like you are too late to the party and you are afraid that the move already happened. I'd really love to know what you're struggling with so I can show you how exactly Orderflow can help you to solve this. So drop your answers in the chat. Again, it doesn't need to be a long answer if you don't want. It can be just 2 words, 1 word, hesitation, fear, no clear signal or no clear entry rules, too late, too early, or anything else, or the fear of loss, perhaps. Tomek says entry rules. Okay, Marco says fear of opening and missing a trade, uncertainty of the entry point. Price can go deeper, so uncertainty of the entry point if it's ready to enter the trade. Don't have a clear signal. Okay, I see. I see your questions, and well, I see the struggles that you are having. And the good information for today's webinar is that this is exactly what we are going to be solving today. We are going to define clear entry rules that are going to signal for you that the price is ready to move in a certain direction. You will be able to feel more confident entering the trade. You will be also able to know that you are not missing a trade, because at that very moment, it's your clear signal that your trade is ready to be taken. When you feel like it's too late, you still will be able to join the movement by some extra confirmations that I will be sharing with you. So right now, let's jump into our first key concept and how to actually see it playing inside of each candle. Okay, so we can start solving those things that you struggle with. And so you can walk out of today's webinar feeling more confident in your trading than ever before. Perhaps maybe not on the first day when you just started trading, but after that, more confident than ever before. Ready? Let's do this. Before we're going to move into the specific signals, let's first understand why is it so important to spot large traders on the chart and why they can be the key to the best entry points in the market. Imagine that the market is like a football match, like a soccer player. You can look at the scoreboard and guess who is winning. Or you can watch the game itself, see who is dominating the field, who is pressing harder, who is running out of steam, and which players does the team consist of. Technical analysis itself is like only watching the scoreboard. You only see their picture on top of it, but you don't understand why the score is the way it is and what is happening on the field. Orderflow is like watching a full game in real time with all the concept and knowing the backstory of every single player. Let me give you another example. Technical analysis, if you are not a soccer fan, right? Technical analysis can be compared to looking at the menu in the restaurant. You see what's been served, a steak, pasta, soup, or something else. Orderflow is like stepping into the kitchen. You see which chef is rushing, where the orders are piling up, what the meat is burning, and which table just ordered 3 times more food than usual, and which ingredients does the kitchen use. That's the real-time mechanics of what is actually happening behind the chart. On a cluster or footprint chart, however you want to call it, we can actually see where real trades are happening and real traders are entering the market, and spot unusually large volumes stuck at the same price levels. These spikes in volume are almost never random. In most cases, they're caused by institutional traders, funds, or market makers, perhaps, the ones who truly move the market. Now, when you see a massive volume print at a specific price level, it's not just a number. It's a zone of interest for a major player or major players. They might be building a large position over there, or absorbing the liquidity, or defending a key level of their entry points. And why does it matter to us, you're asking? Well, because if we know where the big players are acting, we can avoid trading against them, which is likely to save you a lot from many losses. And it's like trying to sprint into the oncoming train, because we as retail traders are very small participants in the market compared to the big players with much, much bigger capital. So if you don't want to trade against them, or better, we can trade with them and ride the momentum in our favor. And Orderflow can help you to identify which direction is with them and which direction will be the opposite, and you don't want to trade in that. And before we're going to move into practical setups, let's briefly refresh the basics of cluster analysis and how to read the footprint chart, because that was a couple of webinars before. This will help you to make sense of what's happening inside each candle and how to spot signals of large activity before price move. I'm not going to go too much in depth because you have the recordings of previous webinars, but we're still going to refresh briefly what is in the core of each footprint candle. We already know that we have the normal Japanese candlestick view, or we can turn it into the footprint chart view. In front of you is exactly the same candle, but on the left side, it's represented in the view of the Japanese candlestick, which only shows you essentially the high, low, close, and open levels of the candle. And you also have the footprint chart on the right side of the same candle, which already shows you much deeper information. The high, close, open, and low are still represented, but beside this, you can see how the volume was distributed inside of each and every single tick outside of every price level. So where were the buyers, where were the sellers, who was active, who was passive, and so on, and how much volume was traded at every single price level. Beside this, we know that on the left side of our footprint, we usually have the bid kind of orders executed. On the right side, we have ask orders executed. And what are those? We already talked that we are the most important piece of information is who is aggressive and who is hitting the market. So on the bid side orders, we have the sell by market orders matched with buy limit orders. So everything that is on the bid side, we have all the sell by market orders that we already executed in the market at that very moment, obviously filled in, so matched with the passive buy limits. On the right side, we have ask orders. And ask orders are the orders that are buy by market and matched with the passive sellers, so with the sell limit orders. So on the left side, we have aggressive sellers and passive buyers. On the right side, we have aggressive buyers and passive sellers. We also learned that we can represent our footprint in the view of delta footprint. What is delta? Delta, as a reminder, is a difference between ask and bid. So it's essentially ask minus bid if we are talking specifically about market orders. Meaning, if the delta is green, it's going to show you that there are more asks than bids trading at this specific price level. If there were more bids than asks, we will see that we had more bids being traded at that very level. The brighter the color of each rectangle of each cluster is, the higher was the difference between asks and bids. The brighter the green is, the more asks compared to bids was traded on this very level. The brighter the red, the more bids compared to asks were traded at that very level. So once we know this, right, we can come to the conclusion that red clusters, and let me move my camera, red clusters represent strong sellers, while green clusters, bright green clusters, represent stronger buyers. If the cluster is barely any color, so it's barely green or slightly red, like a few clusters in front of this on this example, it means there was not much difference between asks and bids, and this kind of levels don't make a big meaning, don't carry the big meaning for us. Okay, so we are focusing on the levels where the disbalance between asks and bids was really significant. So we can come again to the conclusion that red clusters are stronger sellers, and if they are hitting the market, the price should be going down. Where green clusters appearing, it means the stronger buyers are entering the market, and they usually push the price up. We also know that it's not always like this. And sometimes there are troughs that form, and although the delta is bright green, the price is dropping or failing to go up. The same as sometimes when red clusters are bright and showing that sellers should be dominating, the price is still going up or failing to go down. These exact situations we learn how to spot and how to use them in our own profit. So the order flow techniques, right? Now, as we are moving to the practical parts, we are going through the real step-by-step entry strategies for scalping and also intraday trading. Because let's be honest, this is where many traders are missing from their system, from their trading system. This all order flow techniques we are talking about will be helping you to spot where buyers or sellers are dominating, where imbalances are formed, and most importantly, who is actually pushing the price and when. So, enough theory, let's get to the concrete setups. If you guys are ready and if you're following through, can we please put some 777 in the chat? Just making sure that everyone is clear and good to go into the practical aspect of our today's webinar. Can we please get some 777 in the chat to confirm that we are good to go and that if you are following through. By the way, let me remind you that if you have any questions during today's webinar, all the way in the end of our today's webinar, we will have the block of the questions and answers. So if you have any questions, please feel free to put them in the chat at any moment throughout of today's webinar, and I will make sure to go through them all the way in the end to keep things structured. Okay? I see some 777. Fantastic. Thank you for the feedback. And let's move on. Let's get started with the fun part. Signal number one, which we will be covering today, is absorption. So let's break down one of the most frequent and powerful signals that helps us as traders to understand where the market may be stuck or reverse. It is an absorption. So what is an absorption in the first place? Absorption is a situation where the market is being aggressively hit by market orders, but price doesn't move. Imagine the following situation. There is a shop door and dozens of people are pushing hard to get in, but the door doesn't move. There is a big sale, but the door is still closed because someone strong is holding it shut from the other side. That is the practical example of the market absorption. The aggressive side is pushing hard, but can't break through because someone big is sitting at that level defending it. So how does absorption look at the chart? You see a couple of situations in front of you, and let's walk through them. Absorption of sell occurs when the aggressive market sells bump into the passive buy limits, which absorb the supply of the selling side. Absorption of buyers happen when the aggressive market buyers bump into the passive sell limit wall, which absorbs the demand of the buying side. In front of you, the first is an example of buyers being absorbed by a passive big seller, we have several bright green deltas in front of you, which represent the power of buyers. However, as you can see, the price fails to move. It keeps consolidating at the same level and ultimately it starts falling. This is an aggressive buyers being absorbed by passive sellers. They were trying to push the market hard, but still failed and let the price fall. The second situation in front of you on the right side is an aggressive sellers being absorbed by passive buyers. We see the bright red clusters appearing and the price fails to move lower. So sellers are hitting the market and aggressively selling, but the price still continues to go higher. The roles of passive buyers and sellers are usually played by major professional traders or institutional players who possess significant financial resources, because to defend a level, you need a huge wall of buy limits or sell limits. So the big capital allows them to post large limit orders at the price levels they're interested in or wish to defend. So figuratively speaking, they kind of sit in the zones or price levels and absorb the demand or supply created by market orders from aggressive and often less professional traders. So again, on the footprint chart, you will see the situation and the huge numbers at the edge of the candle appearing. At the bottom, if it's aggressive market sells, bid, and the top, if it's aggressive market buys, ask. But at the same time, price fails to break the level or creates a false breakout and immediately returns. So in an ideal situation, during the formation of absorption pattern, higher than usual volumes appear at the support or resistance levels. Before we're going to move on into the practical example of how to use absorption, can you please put 0, 1, or 2 in the chat, depending on your level of knowledge about the absorption patterns. 0, if it's your first time hearing about it. 1, if you heard about it, but you've never used it or you barely used it in the past. 2, if you actively use it, and this is one of your main confirmations when making a trading decision. So please put 0, 1, or 2 in the chat, depending on your level of knowledge about this specific topic. I see some answers. Okay, we have 1, we have 0, we have a couple of 1s, we have 1, 2. Great, we have many, many 1s. So a lot of you actually heard about it, but barely used it or didn't use it. A few of you have never used it before. And a few of you, apologies, actually actively use it in your trading. Well, if this is something that you use actively in your trading, we're still going to move on to the second one. So you will find very useful information a little bit later on as well. And answering the question immediately of Yoza, it is the same as iceberg order. No, this is not the same as iceberg order. Iceberg order is one big passive buy limit or sell limit on one price level. But when the price gets there, their order can be removed and it can be a trap. This is something completely different. It's actually the wall of limit orders which absorbs the activity of buyers or sellers aggressively and actually physically doesn't let the price through. So I see a couple of more questions and we're going to get back to them in the end of the webinar to answer them the best to my capability. So let's move on to the practical examples and the best way, absolutely best way to spot an absorption. Okay? So B and P patterns. This is one of the most common types of absorption that can frequently be seen in footprint charts is volume versus range, and also known as effort versus result. So for example, a typical culmination of buys at the end of the uptrend often finishes with a spike in the volume, but without any further upward movement, resulting in a narrow trading range over one or more candles. The same applies in reverse when a culmination of sell happens at the end of the bearish trend, with the volume also increasing. Sellers try to push through, but market fails to break the level. These setups often are called as B and P patterns because they actually represent and look like the letter B and P. In our case, P and B, obviously, right? On the left side, apologies. So those are some schematic examples that I would like you to take screenshots from, because we're going to be using them practically in a moment, okay? So make sure that you take a screenshot of those patterns, because those are the patterns that can help you to spot the reversal and confirm that the trend or the movement is over. So let's have a look at the example. The price is falling, and at the bottom of the candle, we see the massive volume hitting the bid. But the price doesn't move any lower. So what is happening here? Why the price fails to move? Well, first, aggressive sellers are hitting the market. But there is a huge passive buyer sitting below and absorbing all those sell orders. So he's not letting the price break through. This means that someone doesn't want the price to fall further. So once again, when delta is red, we have more aggressive sellers and buyers. We see the culmination candle, lots of red deltas at the bottom. We see lots of volume at the bottom as well. So a lot of aggressive sellers trading a lot of volume. So they push hard. They try to push the price further, but the effort does not bring the result, and the price bounces back up. The opposite also applies. If the price is rising and at the top of the candle we see large volume on the ask side, as we can see bright green deltas and the increased volume on the top of the candle, but the market doesn't continue to rise, it means that the passive seller is seated above, absorbing buy orders. So how do we as traders interpret this signal? If buyers can't break through the level, the resistance is strong. A wall of passive sell limit orders is holding the price. If sellers cannot push the price lower, the support is strong. A wall of passive buy limit orders is defending the level. These zones often become either a reversal point or a consolidation zone before an eventual breakout. Let's have a look at the other example. So what is the trader's perspective when looking for this kind of situation in the market? Let's say that you see the market approaching the key level. I marked the key zone, the support zone, as a green zone. We see that the price already came to the same zone several times, and each time it was failing to break through. But sellers were nonetheless trying. They were pushing the price towards this zone. So when the price comes into the zone again, that it's been tested before already, you open the footprint and you notice heavy volume near the bottom of the candle. Price tries to break through 2 times, but fails each time. The clusters are filled with red numbers, so bid volume. The footprint forms a B pattern, but the level remains unbroken. This is your signal now that there is a battle here, and most likely the buyer is winning. So you can consider a long entry with a stop just below the accumulation of this red deltas, the red volume. So a simple rule of absorption that I want you to remember is that absorption, now I'm gonna tell it slowly so everyone can make some notes. Absorption is when a lot of orders appear, but with very little price movement. We see at this example in front of you that the majority of the volume throughout this whole movement of the price, the most volume was at the bottom of this candle. The main thing that you should pay attention to is when absorption pattern appears, is whether it manages to stop the price movement or not. So if it stalls the price, you can expect the bounce from this level. So essentially, you once again wait for the next candle first, and then you make your decision. When you're trading footprint charts, cluster analysis, right, you do not want to make fast conclusions. You want to let the price show you what is actually happening. So you wait for the next candle. You see if the price bounces back or continues to fall. And then you make your conclusion. So you see that the next candle was bullish. We see some green clusters starting appearing in this candle. We take the conclusion that sellers were trying to push the price, but their level remains unbroken. If the price level where absorption of market sales took place gets actually broken, the price will likely to continue to move downwards. And as expected in such cases, that former support will likely become a resistance. So very often when price comes back to this previously broken level, because that's where passive buyers and aggressive sellers showed strong resistance and interest earlier, this zone may act as a resistance. So in both situations, you can actually profit from it. You wait for the next candle. If the next candle is bullish and the price bounces back, it was an absorption, and you can take a buy trade, a long trade. If the price manages to break through this wall of buy limit orders, okay, you will be able to sell the market when the price comes back to the same absorption zone. Let me know if we are clear with the absorption, and we're going to move on to the confirmation number 2 and the setup number 2, which we're going to be discussed on today's webinar. So if you are ready, can you please put ready in the chat, and we're going to move to the fun stuff, the confirmation number 2, which we will be using to spot entry points. So exactly like this, yes, we wait for the candle to be closed to determine either their volume was absorbed and price is going to bounce back, or it broke through, and then you still can use the same entry, but in the opposite direction. And Salvador, I do not use a big trade indicator to identify absorption, but you can definitely use it if you find it useful in this specific situation. Okay, I see some ready in the chat. Amazing. Thank you so much for your participation in today's webinar and your communication. I really love it. So let's move on to their imbalances. Imbalance simply means a lack of balance between buying and selling volumes. In other words, it's when one side, buyers or sellers, clearly dominates in terms of volume. In trading, this actually is a positive signal, when a large number often points at valuable trading opportunities for us as retail traders. So in practice, imbalance is visually highlighted inside the footprint charts, and the stronger the imbalance, the more intense the number will be. So, for example, in ALAS, there is a separate mode even that is called the bid and ask imbalance, which compares the volume on a bid level to the volume on the next higher ask level, and vice versa, of course, and it highlights the price level where the one side significantly overrates another. So to be able to open up your footprint chart in ARAS, you open an N chart and you switch the mode from candles to clusters in the first place. Then you will be able to go in settings and turn on the imbalance. I'm going to show you later how. Now, the imbalance is read diagonally. By default, the ARAS considers an imbalance significant if difference between bid and ask diagonally is 150% or more. In real examples, you will often see traders using a threshold of 300% to spot truly large imbalances. And this is also the setting that I will be using on today's webinar to show you some examples. So I will be usually considering the imbalance when the number of ask or bid is 300% higher, so 3 times higher than the other number. So once again, if the footprint numbers are highlighted on the left, It means that aggressive selling on the bid was happening, and this is a bid imbalance. If the numbers will be highlighted on the right, you will see that aggressive buying was happening on the ask, and this is an ask imbalance. Again, imbalances refer to the colored cells in the footprint where one side's volume exceeds the other one by a wide percentage. To sum it all up, imbalance is a visual indicator of aggression. It shows when one side entered the market with a big force, and you can think of it as the someone really huge participant entering the market, and it's going to be overweighting the rest of the market participants and will be affecting the next direction of the price. So in trading, we want to spot this impact really early to be able to follow and make profits following this momentum and force behind them. So once again, let's break it down with a very simple example. Imagine that you're going to see, right? Well, you don't need to imagine it because it's right in front of you. You're going to have the 13 bids and the you're going to leave 2 asks on the right side. That's a more than 300% higher bids than asks, which is a very strong imbalance. So the higher the percentage, the more significant the imbalance is considered to be. In others, you can customize this percentage. It is called overweight percentage to filter out minor signals and highlight only the strong examples. So I'm going to be showing you later how to set your own sharehold of 300%, where the truly only aggressive imbalances can be highlighted, but you will also be able to download the workspace after this webinar, where the setting will already be enabled for you. Before we're going to move on, a quick poll for every single one of you. How much are you familiar with imbalances? Let's put 0 if this is your first or one of the first times hearing about the footprint imbalance. 1 if you occasionally use it or heard about it but never used it really before. And 2 if you are using it professionally to find point free in the market. So 0, 1, or 2 in the chat, depending on your level of experience with footprint imbalances. It's going to help me to adjust the next blocks of today's webinar to your best needs. I see some answers. Thank you for your communication, cooperation, and for participation in this webinar. We really highly appreciate you. Okay, all right. I see quite a few of people here who are just getting started. That's perfect. We also have a few people that already use imbalances quite frequently. That's also really good. I'm going to make sure that although you use it already, you will still find valuable information in today's webinar. Okay, thank you so much. This means that this session will be super useful because we have lots of people who heard it or never heard about it before and not using it yet in your trading. So I'm going to make sure that it can be changed and you can be comfortable and confident trading your footprint imbalances from now on. So let's briefly talk of how to customize your footprint charts in ADAS. So first of all, you open their clusters mode, and you're going to be able to choose the mode bid and ask. This is the one that you want to choose, bid and ask delta colored. Once again, in the workspace that I'm going to be sharing gives you, it will be set for you already. Nonetheless, you can choose the bid and ask delta colored. You can just choose the delta to see the difference between buying and selling pressure inside each candle. Bid and ask itself will be able to display the raw volume separately for buyers and sellers. And you can, in the settings, find the bid ask imbalance settings. You can apply filters, which is minimal volume per cell, to ignore their low volume noise. You can change the colors. For me, it's orange, but you can adjust it to your own preference. And you can choose the imbalance rate to define at which percentage the system starts highlighting imbalance cells, which for me personally is 300, and this is a minimal filter that I suggest using. I won't go deep into the technical setup right now, but you will be able to explore it all inside your own ADAS and the workspace that will be shared with you later. But here is a main idea that I'm trying to share. Through the cluster settings menu, you can first set the imbalance percent sharehold, the colors for bid and ask highlights to make it comfortable and visible, and minimal volume filter. So for example, only showing cells where there were more than 20, 30 contracts traded. So if you set the imbalance sharehold, for example, to 300%, and the minimal volume you will be change, or volume filter you will be able to change to 50 contracts, others will only highlight those price levels where one side dominated by more than double, and there is a minimal amount of 50 contracts traded at this specific price level. So today I'm just giving you a quick overview so you can see what's possible, but once you are down in your workspace, you can test everything for yourself in full detail. So let's summarize. Now we understand what imbalance is. It is a significant difference between aggressive market buyers and sellers at a specific price level. Now let's move on to a more powerful advanced tool built on top of imbalances. Stacked imbalance, one of my favorites. Right? What is a stacked imbalance? It's one of the most powerful tools, for my own opinion, in the ATAS platform. Stacked imbalance is a built-in indicator that automatically highlights a series of strong imbalances occurring consecutively. So in simple terms, it marks up the areas where multiple bars in a row showing aggressive buying or selling pressure, creating a kind of a stack, let me move my camera, a stack of imbalances in one direction. For example, a green stacked imbalance, which you see in front of you, it shows us the sustained buying aggression and potential buy signal. We had several bright green clusters, and we saw several imbalances on the ask side. We had 3 of them being formed on top of one another, and this is what the stacked imbalance indicator highlights. As we can see later, that time comes back to the same stacked imbalance level and uses this zone as a support, which we can consider buying from when the market retests the same zone. On the other hand, the stack of red imbalances would be showing us the sustained seller aggression and the potentially bearish signal to enter a short trade. So essentially, the stacked imbalance indicator compares the buying and selling volumes inside each candle and highlights the zones where multiple consecutive imbalances appear. These zones are known as initial imbalance areas, and they often act as support, as you can see in front of you, and resistance levels if it's the opposite scenario. So let's have a look at this very example, right? Actually, before we're going to move on to this, let's summarize one of the important information. So once again, the stacked imbalance shows us the local areas of strong one-sided market pressure. So it reflects supply or demand dynamics in real time, where we have a row of buyers and buying imbalances plus the rise in price, plus potentially the bright green delta. This is a strong buying pressure and a strong bullish signal. So once again, what you want to see, you want to see the bullish candle or the candle with a long wick to the downside, showing the dominance of buyers. You want to preferably see the green bright deltas in this candle and the stacked bullish imbalance on the ask side. This all together will be giving you the bullish signal for entering trade when the price comes back and retests the same zone. Okay? So let me come to see some questions. Okay, I see a couple of questions, but they refer to the previous part of the webinar. I'm going to come back to them when we have the practice part and answer them in details. Okay? So this is a buying example. What would be our selling example? Our selling example would be we would have the row of sell imbalances, so the bid imbalances. We would have the bearish candle or the candle with a long wick to the upside. And we would have the bright red deltas, which would be a sign of also the selling pressure. So this would be a potentially bearish sign for us to enter the trade when the price comes back to retest the same zones. So if there are multiple bearish imbalances, but the price holds steady or even starts to bounce, it could also mean that sellers are exhausted. So even the bearish imbalance can act as a buying confirmation, and the same way around. So think about this for a second. I have a question for you, just to show you the power of this specific market logic. If you think about this, what is more powerful? The current trend just from the Japanese candlesticks, or the stack of strong imbalances and absorption? What is more like a stronger confirmation for the market direction? Just a trend itself, or stacked imbalances and absorption? What do you think? Let me know in the chat. One, imbalance, a trend. One, a trend. Two, imbalances and or absorption. And I'm gonna tell you what I think about this. Okay, we have several answers with imbalances and absorption. We have one answer is a trend. Good. Let me know your opinion in the chat, and I'm gonna share my opinion with you in a second. Okay. So in many cases, we need to think about this way. When big players build their positions, the trend follows them. So that's why stacked imbalance and absorption can be seen as a leading indicator, and it often reveals the momentum that is building before the trend actually moves. So in my own opinion, the imbalances and absorption are the stronger indicator for us and the stronger confirmation of the trend, because they appear before the trend starts, and we can predict the trend reversal looking at what is happening in the market activity, and we can confirm the trend continuation by looking at absorption and stacked imbalances. So my personal opinion that the option number 2 is much stronger, because it is a leading indicator. It can be considered leading compared to just the candlestick trend and our own it's subjective perspective of a trend. So what does a clear entry signal based on imbalance look like at the chart? So let's have a look at this. We have the bullish candle. This is a strong buying setup. We have the bullish candle with little to no upper wick at all. We have imbalances on the ask side, and we have a stack of bullish stacked imbalance. You can consider, if you have all these confirmations all together, and we also have the bright green deltas inside of this candle, so it's perfect. We have bullish candle with little to no upper wick. We have imbalances on the right side. We have bright green deltas, and we have a stacked bullish imbalance, and the price starts going up. So you can consider entering a trade from either a pullback to the stacked imbalance level plus one tick, or a pullback to the bright green delta in that candle plus one tick. So this is one of your clear entry point confirmation. If you see these three confirmations, bright green deltas, bullish candle, imbalances on the ask side, and stacked imbalance, or at least as many confirmations as you see, as you can find, you are entering either from the stacked imbalance plus one tick, or the green delta in this candle plus one tick. And of course, the opposite scenario also applies. A bearish candle with little to no lower wick, imbalances on the bid side, bright red deltas inside this candle, a bearish stacked imbalance. And if you have these confirmations, you can consider entering the trade from either a pullback to the stacked imbalance level minus one tick, or a pullback to the bright red deltas in this candle minus one tick. So are we clear with these two confirmations? I want you to feel confident with the confirmations of entering the trades. Can we please put a plus in the chat if you are feeling more confident after these examples than before for your entry confirmations? Can we please put a plus in the chat if after these two examples you are feeling like you have the straightforward confirmations to enter the trade? Please take some screenshots. It might be a good idea to take a screenshot of this, to print it out, to put it in front of you when you look for confirmations for entering the trade, so you have the reference. Or put it in the presentation and look at it in the morning before you start trading. I see lots of pluses. Thank you so much for your interaction in the chat and for your confirmations. I love seeing that everyone is clear on that and it's helping. So the last third signal, and before we're going to move some to practice, and I'm going to show you some live example and the Q&A session as well. The combination of the signal number 1 and 2, absorption plus stock imbalance. So after the prolonged trend, the price runs into the resistance zone. At the top of the bullish candle, you see a P pattern being created. High volume with bright green deltas on top. And however, the price pulls back and fails to break through resistance despite the buyer's effort. Imbalance, or the series of stock imbalance, appear, right? You can see the imbalances on the ask side, the stocked imbalance, the bullish imbalance, but the price fails through to break through. The price starts falling and buyers are pushing one more time. We see the P pattern suggesting that the large push of the buyers, lots of effort, but barely any result, and the price starts falling. This confirms that multiple waves of buying had no effect. Price couldn't break through, neither because we had the ask imbalances, buying stocked imbalance, or the activity of buyers and P pattern. In this example, you can consider entering a trade, a bearish trade for the sell, from a pullback to their stocked imbalance, or a pullback to the zone of P pattern when the price enters this. Or you can wait for the bright red deltas to start appearing in the chart, and you can also enter the trade from the next bright red delta when sellers take over the control. Okay? So this is a combination of two signals. Of course, the reverse situation would also apply. I don't have an example of it, but I'm going to have a look at, maybe we can find it on the chart. So if after prolonged period of time of the downtrend, the price reaches a support zone, and at the bottom of a bearish candle, the B pattern forms, so high volume with bright red deltas, trying to break support, but failing to break through the support despite the selling pressure. In the same area, we have the stocked imbalance forming and their imbalances on the bid side. This confirms that seller's effort failed and a large buyer entered the market to defend this level. So you can also consider entering the trade from the stocked imbalance, from the volume zone of P or B patterns, or from the bright deltas that suggest that the other side took off the control over the market. Okay, the theory is great, but let's now make it real. Let's take a look at a couple of live examples so everything falls into one piece. And I'm going to open out the Atas platform now, and we'll analyze a few market situations together. So by the way, the workspace that I will be using today, you will also be able to download after the webinar. So make sure that you return to the same link that was sent to your email about 1 hour after the session is finished. So download the link will be appearing that in the video description. So you click on this link about an hour after the webinar is finished, download the workspace and import into your Atas platform. Once again, then you simply put it into Atas platform and you will be fully ready to apply everything that we've learned today into your real trading. Make sure that if you have any questions, this is a time to pose the questions in the chat. And I already saw a couple of questions, so I am going to be answering them in a moment. While I'm sharing my screen, let me know if you have any questions. I already saw a couple of questions, so we're going to be returning them to them in a second from now on, after my screen is finished, is shared. There we go. There we go. Okay, you should be now be able to see my screen. Let's have a look at some examples. I'm gonna reload my chart to make sure that we have lots of candles showing up. When I was hosted it reloaded the chart for me. And let me see if you have any questions already. Marina is saying the B pattern is not very clear. Please show some examples. I can show you the example here. I had a couple of examples already showing on the chart. So that was a B example right here. So the B-shaped example, you see that the price is falling. You have the majority of the volume on the bottom of the move. You have the majority of the volume on the beat side. So bearish, bright, red deltas with lots of volume. You wait for the next candle for closing above the current level, which suggests the bounce from this level, and you enter the buying trade. This message from the orders, I'm gonna ask the technical team to refer to this, but you can always send email to us or reach out through the Telegram chatbot of Aras platform, and Aras will be happy to assist you with that. Okay, so let's have a look at a couple of more scenarios. Said is asking, I'm exhausted to see the little numbers in the footprint chart. Is there any indicator or a way to see the filter in the usually candlestick view? Most of the time I don't access the large monitors, but just the laptop screen. I've been trading through the laptop screen for 4+ years using the Aras platform. So you can definitely, use it. I'm 100% sure, but of course I understand that you may not be comfortable with it entirely. Now, what you can do, you can go to the settings menu, and you can, in their cluster settings, change their text size to the one that is comfortable for you. So the numbers actually become bigger and your eyes feel less tired when looking at the footprint chart. So the text can be changed here. The font size can be adjusted to what is more comfortable for you. I don't mind the small numbers, but of course you can raise the font size to fit your needs best. Now, that being said, the stacked imbalance indicator is visible even in the candlestick view. So if I'm going to squeeze my chart and choose the candlesticks, you will still be able to see the stacked imbalances. Now, that being said, of course, you cannot see an absorption if you are looking only at the candlestick view, because to spot the absorption, to spot bright red or green deltas, you actually do need to see the footprint itself. So make sure that you still adjust maybe the font size, or you can even remove it entirely, the font, the text, to make sure that you only see the deltas and you are comfortable to looking at it without numbers. Matthew is asking, do you like trading 6E Euro futures in the New York session? I prefer London session, but this is my own preference. I find that the best trading session for you is the one that you're most profitable with. So make sure that you do backtesting. In Aras platform, you have the replay function enabled. So you can actually use a replay to backtest your trading system and find the most profitable times and hours per day when you want to be actually trading. Now let's have a look at this example. What can we see here? The price goes up, right? The price is going up. This is a real-time example on S&P 500 5-minute time frame. We see that the price starts consolidating. We see the move to the upside. The buyers were trying to push through, so that was a bullish candle with an upwards movement. But we have a very long week, and at the top of this week, we have the stacked imbalance. Beside the stacked imbalance, we see that majority of the volume is right here on top of the candle. So if I'm going to turn on just the volume histogram, you will be able to see the majority of volume here. If we are going to be turning on the delta bid and ask histogram, bid and ask volume profile, we will see that we had bright green deltas and red deltas on top. So we had a battle between buyers and sellers. We had stacked imbalance. We had the candle with a long wick to the upside. So we see that the buyers trying to push through but failed, and the aggressive sellers stepped in. So now this zone can be playing a resistance for mini S&P 500, and we can expect the bounce from this level if the price returns here. And this is a live example now of a mini S&P 500 and what can be happening if the price reaches the zone. Okay, let me see if you have any questions. What is your idea between time-based, range-based, volume-based, and tick-based footprint? Yosa, I prefer personally the normal time-based footprint just because of my own preference. But of course, the range XV charts, for example, with a footprint enable also can serve you very well in the markets. Once again, I'm a fan of data-based analysis. So my personal opinion on that is that it's better to test it out, your trading system, and see what works best for you. Let's have a look at this example, what is now happening. We see that again, the price goes up and we have lots of volume happening right here. So we see that the P pattern is being formed in the live example. Now, after this, what we will want to see, we want to see the next candle. If the next candle will be able to break through and close above the P pattern footprint here, if of course it will be a P pattern, we still have 3 minutes until the candle is fully formed, but right now it does look like one. If it's going to be able to break through, close above the stacked imbalance and the P pattern, we will be looking for a buy for a mini S&P 500 for the continuation of the move to the upside. If the P pattern will be formed, but the stack imbalance and the volume on top and this volume will be able to hold the price, we will be looking for a continuation of a sell for a mini S&P 500. Very interesting. You see the P pattern is being formed right now. It's just for us. The market doing it for you so you can clearly see the live example. Let me see some more questions that we had in the past. Vas is asking a very interesting question. How much time do you consider between you have spotted potential absorption zone and the price come to retest it? Of course, it depends on the market. Sometimes the price comes to retest it immediately after the few candles or the next candle. Sometimes it's going to take a few days. Now, my own opinion is that the best is used to use it in the same trading day, because the volume is fresh, and the faster you use it and the faster the price returns there, the better will be a reaction. If the some time passes, I prefer to spot my reversal zones using the volume profile. When using the volume profile, I can use the volume zone, and the zone stays valid for me for the next days, weeks, or months, depending on the time period that you use the volume profile on. So if some time passed, I would give the preference to volume profile, and then to confirm your entry, you open your footprint and you confirm your entry using already what is happening now in bid and ask distribution. So we talked about vertical volume and horizontal volume in the previous webinars. The recordings are available for you and by the same links that were sent to your email. Make sure to rewatch them because they build a core of your footprint, of your market system, trading system, and then footprint gives you entry confirmations, exit confirmations, and helps you to manage your trades to the best way to maximize profits and minimize your risks. And we're actually going to be building the trading system together over the next few webinars. So make sure that you keep attending these webinars, because everything that we've learned together throughout the past series, we will be combining in one powerful trading system together with you in the next ones. Nemsa is asking, does each template that we download from the session need to be added separate to get that session's data? Each and every template is applicable to this specific webinar. And you can, of course, copy the chart and add it to the other workspace of yours, or save it as a template. So for example, if you like this specific template and how it looks, you like the stacked imbalance, you like the distributions of volumes to spot and absorption, and imbalance is enabled, you can go here, you can click on the templates, you can click settings, and you click add the template. Now the settings are going to load here. You can click add, you save it as a separate template, and then you use the template to add in your separate workspace. Waswad is asking, how do you control your emotions when see bright clusters forming and enter and not to enter the trade? What confirmation do you use when you see that price absorbing? First of all, you always wait for the next candle. So you need to develop yourself a habit to not jump into the trade immediately, but actually wait for the next candle to confirm where the market is going to go. So you wait, like now, for example, we see the P pattern. We see that this candle is being held below the stacked imbalance. I see the P pattern, but I'm still waiting for the next candle before making my decision. Because if the next candle will be able to hold the P pattern from here, this P pattern and the stacked imbalance, then I'm going to be considering short. But if the next candle will be able to break through all of this and close above all of this, I'm going to be considering entering buy for the trend continuation. So the most important is patience. Just you teach yourself to wait. But also in the next webinar, we will be covering something very, very important. We will be talking about the risk management techniques, also from the technical and psychological side. So make sure that you attend the next one. Let me answer a couple of extra questions and we're going to be finishing off today's webinar. Thank you for the basic information. Knowledge, how can I go more specific and working? Just, okay. Leon, I don't know what you mean about their basic information, because throughout the previous webinars, I actually gave you the specific tools, setups that you can combine in the trading system. And on today's webinars, I also gave you 3 different setups that can be used directly for entry points. And I use them when I trade. So this is actually quite an advanced information that you can use to spot very profitable opportunities in the market. Yeah, actually, Paul, I agree with you. Funny how having the years demonstrating a live example. Exactly. We have a live example right now. And I'm waiting for this candle to close now, and we will see if this candle closes bearish, which is trying to do. This is going to be a confirmation for the short example as well. The strategies, Lion, were discussed over all webinars. This is what the webinar series are about. We, on every single webinar, talk about live examples, and specific situations can be used for entering trades. And all of these situations, by the way, can be also used to exit the trades, which is extremely powerful. Because let's say that I'm in a buy for a mini S&P 500. I see the price going up, creating the bullish stacked imbalance, but failing to go up and started bounce back. At the same time, I see that majority of the volume was on top of this candle, and the price also goes down. I see the price comes higher again. We see the bright green deltas. We have another P pattern here formed. So once again, the buyers are demonstrating the power, but the effort is barely any. The price once again starts falling and trying to create the next bearish candle, still holding below the volume of this P pattern, of this imbalance, and this P pattern as well. So what does it tell me? It tells me that buyers are trying to push the price through. We have lots of volume on top of each candle, but barely any result comes from this effort, because they are unable to push through this gray zone. This gray zone represents the area where we have lots of sell limits. We have a wall of sell limits that the price is failing to break. So this is a live example of potentially short trend trade. We can see how the price starts falling, you see? So this is telling me that this is a good moment to sell. I can sell if the price comes back to this bright green delta and the red delta and the point of control of this candle. Or if it doesn't pull back here, I'm going to wait for the next candle to form and to show another bright red deltas as a confirmation that sellers stopped in the market. So this is going to be one of my entry points. And if it doesn't give me this entry point, -1 tick, I'm going to wait for the next one. And this is a live example of everything that we talked about on today's webinar applicable in the practice. Yeah, that answered the question. Perfect. The workspace will be available to get downloaded 60 minutes approximately after the webinar. So right after the webinar is finished, we are going to visit Ada's team to put the link to download this workspace, which you can download, import into your Adas, and you're going to have exactly same, not only settings, but even the drawings, even the markups for mini S&P 500 that you can use to enter the trade potentially. When we download the template from your session, then we import them into the templates. Yeah, you import them either in the templates or in the workspace. In this example, it will be workspace. So you will need to go to the main Adas window, go to workspaces, and hit the import button. So it's going to be the full workspace available. Okay, thank you so much for your activity. If I missed anyone's question, or if you have any questions appearing after our today's webinar, please make sure that you send us an email or the question in the Telegram bot, and we're going to get back to you and answer all your questions and help you with any struggles that you may have. Our mission is to obviously help traders to become profitable using order flow analysis, volume profile, and all the other variety of tools that Adas offers. So let's quickly wrap up what we've done today, and we see that S&P 500 is beautifully rejecting this level, which is a perfect example of everything that we've learned today working live. So on today's session, we were all about finding high probability trade entries using order flow. We didn't just talk theory. Obviously, we looked at how the signals actually show up in the chart and how you can read them using footprint delta, cluster visualization, stacked imbalances inside of Adas platform. So here is a quick summary of what we covered. We talked about, firstly, large trades matter and how they often signal the interest of big players like institutions, funds, and market makers. And spotting these trades help us avoid going against the train and instead ride the momentum of the big market players. Then we export the first key signal, which is absorption, where aggressive market orders are stopped by passive limit orders and how they can often mark a hidden level of resistance or support. You also learn how to recognize the absorption by large volume at the edge of the candle with no follow through in the price. We also broke down the P and B patterns on the footprint charts, showing how volume distribution helps us to spot failed breakouts or market exhaustion as well. And after that, we looked at the imbalances and stacked imbalances, which is a powerful sign of dominance from one side of the market. So we explored some real chart setups, and we also talked about how to configure some footprint charts, color filters, and how to activate those all settings in your own Adas platforms. So once again, everything that we've learned today is practical and repeatable. You can adjust it to the higher time frames or lower time frames. My preference is, of course, 5-minute time frame because it's easier and it's actually less numbers, because Said, you were saying that you are tired of lots of numbers. The higher time frame you go, the many more numbers you will have. So it might be more tricky. I would try to either go lower for range XY charts or the 5-minute chart as you see in the example. Okay. So we are going to be talking about how to place a stop loss and take profit in one of the next webinars. So please make sure that you tune in. And yeah, and we're going to cover a couple of more questions on the next webinar. So make sure that you come back and we're going to talk about this as well. A quick reminder, the recording of this session is available right after our webinar, about 30 to 60 minutes after the webinar is finished, through the same link that was emailed to you earlier. And make sure that you revisit the same link from the email, open the video description, you'll find the download link there. Once you import this workspace into your ADAS platform, you will have all the settings, indicators, filters, and charts view that we were using today ready to go. So that's going to be perfect for back testing and applying everything that you've learned today. You can apply it through the replay function in ADAS platform. So what's next? Our next webinar is going to be next Tuesday at the same time, same place, same platform. So make sure that you join us for the how to build your trading system and the risk management aspect. Thank you for joining us today. If you enjoyed the session, please write a quick comment in the chat. Helpful, clear, and want more like this. And I really love to hear your feedback. So make sure that you give us a feedback if you'd like to see something more specific also on the next webinars. And as always, I'll be there for your Q&A next week. So if you have any questions left, make sure that you come and we're going to solve all of them. So thank you so much for being here with us today, and I'll see you in the next webinar very soon back.